Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 6:50 a.m. on Tuesday morning, February 20th. Just off a Fox Business Mornings with Maria appearance. And this is the free version of our weekly audio and video summary of our note. Our note this week was titled Expectations Convergence. There were three sections to it. Primarily, this was a deep dive into the inflation data that we've received and the inflation outlook. We began by talking about this expectations convergence, the idea that we've now collapsed the gaping hole between the market expecting the Fed all the way to cut all the way to 4% and the Fed thinking that they were only going to be cutting to about 4.75% this year, and what the implications of that are for the markets. We then moved on to a brief section about the future of quantitative tightening. That was prompted by the RRP balance, Fed reverse repo program balance falling below $500 billion, and what we'd like to see the Fed do with their balance sheet over time. And then we really dug deeply into the inflation outlook. So first on the markets, we've basically got two dynamics going on with the Fed. There is the Fed cutting because they can, this idea that disinflation will provide them the room to cut rates. They expected to see some of that hence the cut to 4.75 that they had projected into the December summary of economic projections. But then there's the Fed cutting because they have to, what we've been calling the quadrilemma, the idea that for them to cut to 4%, the level that we think is necessary to disinvert the yield curve and open the bank credit channel to allow banks to help refinance the some nearly $1 trillion of commercial real estate loans that are due this year, along with the amount of government debt, another $2 trillion deficit, 500 billion of extra coupons in the first half of the year, that they would need to cut that much. In order for the Fed to cut that much, they won't be cutting because they can, they'll be cutting because they have to. The idea that the unemployment rate goes above 4, wage growth falls below 4, and that allows them to cut to 4 and keeps the 10-year note in the vicinity of 4%. We're dealt a major setback on that front with January employment data and inflation data. Now, some will look at this and say the same thing's happened now 3 years in a row, so there may be some statistical quirks related to the pandemic. We're sympathetic to that view. However, the inflation story runs much deeper than that. So before we move on quickly to the inflation story, the idea we have around the Fed's balance sheet is that what they should be doing is going back to a bills-only policy. That was the policy that was in place after the Fed Treasury Accord of 1951 through the Bernanke and quantitative easing. And the idea is any coupon Treasury that mature, they should be reinvesting them in bills if they need to provide liquidity to the banking system or money market system more broadly. And any mortgage-backed securities that mature, they should, again, be only reinvesting into Treasury bills and try and shrink the duration of their portfolio so that they have less influence on back-end interest rates, which we think are crucial. This could prevent capital misallocation and, frankly, stop facilitating excessive government spending. So as far as CPI goes, we're very much in the position we were in through the 2000s and the 2010s, where goods deflation is providing all the disinflationary impulse, and domestically determined housing inflation and non-housing services inflation are running well above the Fed's target. This caused the Fed to keep policy more easy or more accommodative than they should have otherwise back in the 2000s and 2010s in particular. And they're back in that same position. So if we think about non-housing services and what's occurred over the last 6 months, that was averaging about 2.25 per month in the first half of last year. The supply of labor was improving. The Fed thought this is perfect. Everything is proceeding on plan. But in the second half of the year, that accelerated to 0.4 per month. And that was true through January. This wasn't just a January phenomenon. And at the same time, we saw retirements in the over 55 category pick up. We saw labor force participation in the prime age workers, 25 to 54, retrace some of the gains in the first half of the year. And shockingly, the BLS estimated that the population shrank by 625,000 workers in the second half of, or through the whole course of 2023. So that's going to have the new Keynesians at the Fed quite concerned. That combined with the fact that housing inflation is not coming down, we think the Fed damaged the supply of housing alongside the weakening the demand for housing and actually exacerbated the housing crisis. So we're not optimistic that housing inflation is going back to 3% where it sat for the prior 20 years. And so we've got a real sticky wicket here. We're going to need the labor market data to deteriorate decidedly in the next few months for the Fed to be on track to cut rates fairly aggressively. So that's it for me this week. If you're not a full subscriber, we'd love you to consider becoming one. And we will offer trials. Send us an email. We're happy to do that. Have a good day, everyone. Thank you.